Good morning and welcome to this week's edition of the Daily Energy Markets Month in Review, Month Ahead Outlook. And there's no doubt there is much to discuss. I actually wrote it down on a sticky note, the month in review since we last had these two gentlemen on the show. We started a month in review. We had the decision by OPEC to postpone its increases. We had the Fed rate cuts. We had the China stimulus. We had the hurricane season in the US that's still playing out. We had the infamous Financial Times article telling us there was going to be an OPEC plus price market share battle. And then most recently, escalated threats of regional war in the Middle East. It's a long list of things to reflect on. Mike Muller, head of Vitol in Asia. What stands out from you in the month that has passed that we'll still be talking about in a month's time, that maybe will have more legs rather than be moments of a kind of spike moment? Your thoughts on the month in review?
This is normally the busiest month of the year for most people in our space, just in terms of getting ready for next year. And it's the time of year where you look forward to the next year in terms of term commitments, relationship building, strategy sessions, etc. So, yes, it's been amped up by a lot of news. Maybe I'll leave the geopolitical developments to one side for now because everyone's been following them since they're so high profile. I was surprised by the reaction of the markets to the China stimulus package, which was initially dismissed as, well, okay, they're trying, but they're trying to, accomplish something which is very, very hard to move. Right on the cusp of Chinese Golden Week. So China's been on leave for the best part of since the middle of last week, and they will continue to be on leave until the middle of this week. And therefore, with markets closed in China, you've got a lot of talk of where the informal markets, the OTC markets are. But just before the holiday, equities markets and certain key commodities, not oil, by the way, but certain key commodities linked to the construction sector, which is the one the Chinese government really wants to give a stimulus to, did move. And China kind of caught a bull wave, if you like. And everyone I know in China is either anxious to buy more or wishes they bought more or is actively getting long the stock market. So it really looks like the government has decided to set about it with some purpose. In terms of oil markets, I mean, yes, we cycled up to close to, well, we got above $78 and we're sitting around about there now. That is a price that few would have picked, but people are debating what sort of premium to place on the risk of disruption to critical oil and gas supply infrastructure. In the case of Gaza, we've been talking about it for many, many months. There's a lot of gas infrastructure very nearby. There's a dependency on Israeli gas from Egypt, for example, which not many people talk about in oil circles. And on the oil side of things, I mean, I guess even fewer people currently wish to send ships through the Bab el Mandeb as the Houthis continue rattling that supply chain. So the market has gotten a lot more bullish. At the same time, we're at the tail end of summer consumption season. So key indicators people watch, like inventories of gasoline in the US, are very, very low. There's been a big draw of inventories on the water of refined products. Of course, we've also been and finished trading the key refinery turnaround season, and that's been exacerbated a little bit by Libyan oil going missing, mostly in the month of September, and also exacerbated by the traditional stock draws I talked about. So suddenly, a lot of the oil markets, be they diesel, kerosene, even gasoline, and of course crude, feel a lot tighter than they did a few weeks back. And everyone has had a slight change in mindset, saying, well, given that, and I'll finish with this, given that a lot of the speculators in the markets, the managed money in places like New York has been off the oil market completely. In fact, some have even been short. That risk-off mindset may no longer be appropriate given the geopolitical events we've been watching. And there's been some evidence that some of that money has been coming back into the space. And that's got the potential, of course, to cause a market which is more volatile.
Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christoph, welcome. Obviously, your thoughts on that list of September into early October developments, and one additional point, which was just at the end of last week, with a lot of things at the end of last week, but additionally, a sort of bumper jobs report out of the US showing a pretty healthy economic outlook there. Your thoughts on reflecting the month?
I think the only way to get through this maze of events is when you systematically try to disentangle transitory from more permanent effects and forces at work here, as we have done many times on these Sundays. When I look at that, then I'm starting also dodging the geopolitical bullets for a second and then starting with the economy. I note something which is kind of strange because there seems to be a much more binary world now in which we are living when we look at the connection between markets and the economy. Somewhere around 85% of all investors seem to believe that the US is in for a soft landing, according to surveys. Somewhere like close to that number, maybe even more, must have until the end of previous week, the week before the last, have believed that China is going to the dogs. And there was always this attitude. I was, as you know, always skeptical of this saying that China is going back to 15% growth or China is going to minus 5% growth. Always thought it would stabilize somewhere in the middle. That's what they have done right now. And the exuberant reaction it causes speaks of a lot of people who have been caught out and are now going to crowd back into that market, and sentiment completely shifting, which will be equally wrong because China is now a 4 to 5% economy, which is very good by global standards, but it's something to get used to. And similarly, I think by these unpredictable events in the Middle East, now people must have caught on big time on the oil market. And everybody was convinced that the trend is now down, that supply in the fourth quarter and in 2025 will exceed demand. And the geopolitical premium, if you can call it that, is sort of keeping it above where it used to be, but with a downward trajectory, with a downward trend. I think it pays to keep in mind that whatever happens in oil markets, it will be transitory. There's huge amount of spare capacity in that market. There is a completely changed landscape compared to the 70s, and the US being the largest oil producer and becoming more and more important also as an exporter, but simply by dropping out as a major importer to change the game completely. But on the other side, without wanting to speculate, if you put yourself into the shoes of the main actors, then there never was a moment in time probably for Israel to be decisive against Iran, maybe beyond oil, maybe even other parts of energy, allegedly energy, than there was at the moment. So if I try to sort of put the puzzle together from that side, I think it is really a quite explosive situation at the horizon, potentially. And that, of course, will overshadow everything else. And when that settles, we will still be left with a global economic recovery, most likely with stabilization in China, with finally removal one way or the other US election results, and the uncertainty about US election results. And that gives a longer term, not a bad outlook, I would think, despite the current clouds.
Mike, if we sort of take one of the threads through the last month and that continues to be relevant, and that is the OPEC decision that started the month on the eve of APEC, which you and all of your colleagues there hosting APEC, the biggest gathering of energy market stakeholders each year in Singapore. The OPEC announced that it was postponing its increases from October 1st to December 1st. Then, sort of some halfway, 2 weeks or so later, we had the Financial Times article announcing that the Saudi sources were telling the Financial Times that they were ready for a market share battle, war, however language they were indicating. And then even in the last few days, the OPEC noise is churning out stories. Wall Street Journal reporting that the Saudi minister had mentioned or threatened a $50 price if compliance actors didn't get involved. Now, putting aside all of the geopolitical traumas that are currently in the mix, but just taking the OPEC strategy through line, how do you see that, what we've all heard together, and truth or untruths to it all over the last month? how important is continued managed supply by OPEC to the through line going forward to the next month?
Yes, Sean, if you cast aside all the geopolitical noise, it is extremely important that OPEC Plus continue to show a consistent strategy and do what they say they're going to do, because the market, it does hang a lot of forward hope on that. The price that we see today, of course, $78 Brent is a price that nobody's particularly unhappy with. OPEC should be quite happy with, but there is a possible scenario where if the fighting were to stop and the world were to calm down, then some of the fundamentals Christoph is outlining would restore the inventory draws and bring back a balance. And most analysts see modest stock builds early next year. That would bring the market into a regime where people are very certain of the spare capacity being a reassurance, a cushion under the market, and we may well cycle lower. So I think APEC indeed was a bear frenzy that ended up slightly overdone. Indeed, halfway through APEC week, the market went bid again and shied away from those very low 70s and high 60s prices that we'd seen. But there was a reason for it. Everyone got worked up after comparing notes on China in particular. And that's the economy that's responded with a stimulus package that has caught a bid, not just in Chinese circles, but I'm sure there are plenty of investors sitting here in Singapore that are trying to find ways of getting long China also and making sure they don't miss out on what seemed to be an oversold market. Nobody's had much joy buying Chinese equities over the years. This has not been a market that's rewarded shareholders, and people feel this might be a bus they wish to catch. But I think there's been a lot of clarification which has been helpful on the part of the protagonists you mentioned, in terms of non-compliance or under-compliance being rectified and being compensated being extremely important. And some key nations were brought into the public view on that. And then there's been some fundamental announcements also. There would appear to be some production cuts or some maintenance that is quite profound in the Emirates where you're sitting, which will take a significant amount of the key benchmark Murban crude off the market. Just after refinery turnaround season, and traders took that on board and are now believing that's a scenario which will also bring down OPEC Plus output quite substantially. I think anybody who says that the resumption of production and the higher levels of output from OPEC Plus from December is bearish. It's a little bit wrong to say that, because that was always the plan, right? That was always a production increase that was meant to mirror fundamentals. Asia, let's not forget, Asia demand for oil peaks in December every year. And as such,
just on that point, sorry, Mike, you mentioned earlier, I just wanted to drill into it a bit, because a lot of discussion in the last few weeks about, if you take the FT article at face value, who exactly was the target of that information? And the general answer to that question was those countries within OPEC Plus that are not complying with their cuts. Is that of a scale, do you think, that makes a difference to the trajectory of this market? The Iraq, Kazakhstan compliance versus not, is that of a scale?
Well, it adds up, right? Every little bit matters. So if you're talking about a few 100,000 barrels a day, it can tip balances. Multiplied by 365 days, you get some very, very big numbers if you're talking, say, 200,000 barrels per day or so. So yes, it is important to show that there is no drifting, and that there are multiple countries, not just one country, taking substantial sacrifices in order to stabilize markets as they've set out as a consortium to do. Yeah.
Christoph, I mean, Mike mentioned there the bearish sort of dialogue that was sort of defined APEC this year. We just had our annual forum in Fujairah last week. That bearish tone was quite strong as well. There was, in our leadership roundtable summit, there was the analysts that were presenting to the industry leadership were even more, sort of battling to be more bearish than each other in the numbers of 500 to 600,000 barrels a day growth this year, rather than the million plus that we had been even talking about a few weeks ago, that the growth this year is essentially stagnant. Your thoughts on that as we're now into the fourth quarter, demand growth for 2024 and its implications for the direction of this market?
It will not be zero, I don't think. That would be too much of a fall from where we are. But I mean, again, excluding geopolitical events. But it's clear that for once the IEA had it right, and OPEC accordingly still has it wrong. I mean, look, step back. There's this old saying, if you find yourself in a hole, you've got to stop digging. What has happened in oil markets over the last few years was first a massive, massive, massive shift on the supply side with all this shale business of which we know, and now with other non-OPEC jurisdictions coming on. So non-OPEC supply continues to rise. And then it was a massive, massive shift or shock on the demand side with COVID, and a little tiny bounce after that. And then kicks in this, what I call this strange thing that sentiment has become so binary. The gloom on China was so big that in every financial institution, I'm aware, the macro guys were pessimistic. And then that spilled over to the oil analysts, and China became so the boogeyman because of demand falls in China, oil markets would come under pressure. If you add these two sides together, you have a decline in demand, which is most likely of a secular nature and may lead to a plateau or peak oil in the next few years. That's just what I see in the numbers. And you have a continuous expansion in supplies of exactly that kind of provinces which can survive only with decently high prices and which are outside OPEC Plus's control. In Brazil, in Norway, in the US more than anywhere, in Guyana, you know all the names there. That leads towards a situation where if OPEC continues its policy of the moment, and even if it disciplines more, prices are artificially high, market share is going to get lost, and they're boxing themselves in a corner. That's what I mean by stop digging. At some point, this will break. At some point, it will break either by falling apart because discipline can no longer be maintained, depending also what happens again politically with Russia and all that, or it's falling apart because of a step of the leaders of OPEC to say enough is enough and we need to really reinforce the system. And then you have what the Financial Times was speculating about. I agree the article was mostly just targeted, but I also think that shoring up this is not a central bank, shoring up the institution, making it disciplined, so it does not solve the secular problem. If anything, it brings it forward. And the secular problem is one that these markets will continue to shift away from control of OPEC Plus very rapidly if peak oil or oil plateau happens. And in the numbers, the way we use oil is becoming so much more efficient that most likely within that decade we are at this point. And then we're facing this race to the bottom. Then the only way in a shrinking market to survive for a producer and to keep its market share is or to keep its volume of exports into that market, is to increase its market share by definition. How do you do that? Sooner or later, you compete on price. And what does that result in? That results in a price decline, which is not managed.
Mike, so your thoughts as well, just taking that China part of that bearish demand growth outlook this year, the stimulus you mentioned in your opening comments, the equity markets in China have certainly reacted incredibly positive to that, but essentially they were on death's doorstep anyway, so a bounce from sort of a very low level. But the impact, the stimulus package, what's inside it, could it indeed succeed in giving China's oil demand a recovery for what appears to be, and now and more voices saying that China oil demand growth will be near flat this year?
Well, I mentioned before that a lot of Chinese colleagues I know are buying equities, but a lot of them are also looking to take profit and feeling enriched. So they've spent the holiday period changing their holiday plans for winter holidays in the Alps instead of some province of China. So there's extra jet fuel consumption, very, very graphic, and just take as an example. I know two other colleagues have ordered a new car. Now, obviously, cars that China's churning out, subject to a lot of tariff discussion, but even domestically, there's been quite a price war in terms of, battle for market share. So
what, the 25-30% jump in the equity markets has made your average punter feeling richer?
Yes, that's right. And spending on consumables, which includes energy consumption. Yeah.
And beyond that, from the point of view industrial or otherwise, where do you see that trajectory going for China into the sort of Chinese New Year, typically a strong buying period?
As I said, the one sector they really want to fix is construction. And I've even seen people putting down deposits on second homes and getting emboldened by the whole wave there. I mean, it is beggars belief how much this stimulus has exceeded expectations in terms of its impact. Because on day one, my take was this is hardly going to touch energy. It'll influence a few other sectors. But even certain metals markets that you'd associate with construction have taken off.
We have to be careful again, no? Because the real question is, Mike is completely right when I look at equity markets and financial markets. The real question is, what does it do to the Chinese economy? And the Chinese economy is not a traditional economy where you talk about the size of stimulus and then it really doesn't quite matter where it goes. The Chinese economy is one which is still skewed towards industrial production, towards exports, not enough consumption-led, it's still on this trajectory, which the government, by economic and political management, continues to obstruct and delay. And as long as that is the case, these stimuluses will be targeted to sort of avoiding the worst and stabilizing the ship. Not yet. The stimulus is not yet targeted at turning around that ship by saying, okay, now we liberalize financial services, we liberalize the service sector, we don't force our government expenditures into the property sector anymore. That's their dilemma. They know probably that they have to do that. They do it gradually, including scaling down the subsidization and government expenditures in construction everybody talks about. But it's not the only problem. They have zombie banks and all sorts of things. And there is a need to extinguish these single fires, which they can do, but I don't see the political will to really steer that ship out the final steps towards a complete market economy to rectify these structural biases. And as long as they are there, the growth rates are going to be lower than what we are used to.
And you also have, Christoph, and I'd welcome your thoughts on this. Obviously, you'd been on the ground in China earlier this year, but the data remains opaque in China. We hear the headline announcements. Mike gives us a few anecdotes there of his colleagues spending some money, but ultimately the official statistics may not accurately sort of reflect in any real time, at least, some insightful data points. Your thoughts on that, the opaque nature of China at this particular time to give confidence and guidance going forward?
Yeah, I had my own experiences when we produced the statistical review with China's statistical agencies. And yes, the data is not only opaque, it's sometimes positively, it's manipulated sometimes. That's just, I think, a correct statement. I mean, I talk to my friends in China, it's still a correct statement. Now, I found it particularly difficult over the course of this year with the concentration among oil analysts on Chinese demand. And the reason for this is, of course, that so much of Chinese consumption now comes from Russian oil. And there's no question here about whether this is manipulated or not. We don't need any conspiracy theory about manipulation to understand that these numbers are probably pretty random and not very reliable. They are patched together from different outside observers, and the actors have all sorts of incentives to obfuscate, light on what is really being traded. That's why I continue to be amazed by how much stock the community of oil analysts really places on Chinese demand projections. In a situation where the numbers are so bad, to talk about weekly fluctuations as many people do is to me not very constructive. I'm glad I don't have to forecast it.
Yes. Well, Mike, I wanted to get your thoughts on the moment that we're facing literally today without getting into the weeds of the geopolitics of it. But we have had announcements last week that from the US president himself and the Israeli government that they are planning some reaction to the Iranian strike on Israel earlier last week, which all put 10% plus on the oil price through the second half of the week. My question to you is, from a supply demand point of view, I thought actually 10% didn't seem that much, given what even the US president said, that targeting oil facilities was under consideration. Where is the market's ability at handling perhaps a serious disruption of 1 million to 2 million barrels of oil of supply at a time when, of course, we know OPEC Plus has close to 5 to 6 million barrels a day of idle supply? How big is that balancing factor, risk factor to the market?
Yes, it is a fact that Iranian exports have almost been at their full capacity and therefore have gone unchecked despite a world where sanctions are in force. And this is obviously something that is not lost on people, as if there were to be some compromise of Iranian production or export capability, it takes away from that supply cushion, that spare capacity that Christoph was talking about. But of course, taking away supply security in the shape of a spare capacity cushion is bullish, because it means there's less capacity then to cover for other geopolitical disruptions. And therefore, surely that is something that an administration looking to get re-elected does not wish to see, if in so doing the oil price goes up. So there were a few statements, retractions, and I'm not quite sure which statements were correct or fake news made up by the media at some point, and there seems to be quite a lot of it. So yes, the market went from being quite divided in oil trading circles on whether there would be a retaliatory strike on the part of the Israelis, contrasting it to the April, let's call it tit for tat exchanges, where there were some widely telegraphed retaliatory moves which didn't cause material casualties, and that was it. People let things rest. But this obviously is on a scale that looks somewhat different. So I detected that Thursday, Friday, as we moved into the weekend, there was a shift from 50-50 to more people thinking there would be action on the part of Israel, who, as Christoph said before, seem to be acting as if they have an opportunity here, which hasn't come along all too often, to act unilaterally. And I mean, you've seen protests in the streets. I saw some photographs from a colleague that was posted on one of your chat groups, Sean, of people protesting in Trafalgar Square. I mean, ethnic Jews protesting, yes. So the world is quite confused in terms of where all this is heading. But yes, volatility went up. People are looking to get long call options to give themselves upside protection. And people are talking the possibility of $80, $90, $100 oil again in the event that infrastructure does get hit. And that's why I made that point at the very beginning when you put me on the spot. It's a judgment call on whether there will be any compromise in supply to global markets from the Middle East region.
Christoph, I wanted to get your thoughts just looking forward to the sort of trajectory of monetary policy, which of course was a very big dominating subject through September, even with all of the sort of rising geopolitical crisis in the region of the Middle East. Nonetheless, monetary easing amongst the G7 economies is well now embedded. And we're now talking about the next US Fed cut in November. Your thoughts on that, on its outlook and its impact, and what does it tell you that the Fed is cutting, and guidance appears to be some more fairly robust cuts? Is that a healthy economy, or is that to avoid a crash landing? How do you read going into the fourth quarter now all of the monetary policy making across the G7 economies?
Give me 10 seconds on the previous question too.
Please,
Because I think there's again the signpost here which is worth watching if one doesn't know. You talked about that gingerly this may move from expected signaled attacks in April to something which is really sort of more serious. The signpost to watch for this is of course the infrastructure damage which comes with any kind of disruption of oil markets. Just very briefly, it's one thing to take out, say, as an example, a few tankers, and then there's quiet and this will be fixed quite quick. It's a short-term disruption. Very different thing from taking out a pipeline or infrastructure and damage it to an extent which takes years to repair. And that will be sort of my milestone to watch whenever there comes a reaction, and if and when it is directed against oil and gas markets. Where was it targeted? Short-term disruption or sort of lasting damage? On the monetary policy, the picture remains fairly unchanged. So it may make one suspicious that now there's this huge, massive, belief in the soft landing all of a sudden. But from what we know about the numbers, that seems to be still justified. It seems to be that the US really sort of comes to a soft landing. There is a danger of inflation ticking up a little bit if job markets turn out to be positive in this vein for much longer. But I think that also the US just has these hidden reserves and has this very bad labor market data. So I'm still prepared to think of interest rates coming down, maybe not as rapidly as some think, but gradually over the next few months, including after the election, putting whoever wins the election in a good, decent starting point, and then we will have some fresh initiatives in the economy, whoever wins. And when you go around the globe, Europe will go further into a low interest rate because they're growing much softer. The UK will follow. And as we have seen, even China is gingerly sort of trying to strike this balance between releasing more demand in its economy, more real demand, without re-inflating some of the bubbles, including but not limited to housing, which they are just trying to have to deflate. So that's a very tricky thing to do. but by and large, they do have the capacity. Their problem is much more deep and structural and fundamental. So in the short term, for the rest of this year, geopolitics aside, there is a reason for optimism on the economic side. And if the geopolitical situation gets resolved one way or another, then that would, of course, add to the positive impetus. So despite the gloomy Sunday today, I think thinking beyond November 7th, which is another 7th, which is important, that's the US elections, there's more reason to optimism than we tend to think at the moment.
Mike, last word to you. What will be your kind of North Star through the fourth quarter? We asked at our forum last week what the forecast for the average price of Brent crude in the fourth quarter, and that question was asked after the Iranian strike on Israel, and the answer was $70 to $75. What do you think is of the number of things that are up in the air, and we mentioned them at the beginning, will give this North Star direction for the oil markets in the fourth quarter? Is it whether OPEC increases in November or December 1st as planned, or is it the US election? Where do you think will have the biggest bearing on the direction of this market over that 3 month rather than, let's say, this week?
I'm afraid it is the short term. I mean, the market has a pretty range-bound mindset. If we were to take away all the geopolitical events in the last few weeks, which had the market adjusting its mindset from a 70-85 market to maybe a 60-80 market or 65-75 type range, we're outside that latter range now because there's an expectation of disruptions and ongoing hostilities around that Middle Eastern region. But yes, you call it North Star is, I mean, OPEC cohesion is something everyone's going to watch, so that is important and must be maintained because that's your underpinning foundation of the oil price. And then it's going to be demand. I mean, everyone can judge supply. Everyone can make assumptions on the disruptions or even areas like Libya, which have been a little bit fickle. But these constant downward demand revisions have now come to an end. People are probably going to look at revising Chinese numbers back up again because those might also have been overdone on the downside. And then whether that 500, 600,000 barrel a day figure that was floated at your forum is and that's oil only, by the way, not NGLs and petrochemical use of NGLs, that sort of stuff. That may well go up again. But the undeniable fact is we have more non-OPEC oil coming on than we have demand in the current set of rather bearish outlook numbers. And that poses an ongoing challenge for OPEC Plus to manage.
Well, we're going to have to wrap it up there. I mean, this could be a significant day that sees oil prices tomorrow dropping by $5 or jumping another $5. It's sort of any one of the two, and it's hard to obviously call. My sense is that this response from Israel won't be quite as muted as April, but I don't think it'll be as devastating as kind of the expectation was last week. Somewhere in between something, because ultimately I don't think the Iranian strike did any real damage. It was more theater than impact. We're going to leave it there. Mike Muller, head of Vitol in Asia. Wonderful to see you, Mike. Hopefully catch up soon. Christoph Ruhl, senior research scholar, Center of Global Energy Policy, Columbia University. No better two analysts to start the month with than these two guys. Thank you. Have a great day, great month. All the best.